Ladies and gentlemen, good day and welcome to the Q1 FY27 earnings conference call of Steel Authority of India, hosted by Nuvama Wealth Management. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Kejriwal from Nuvama Wealth Management. Thank you, and over to you, sir.
Thank you, Eric. Good morning, everyone. Sorry for the delay to start the conference call. At the outset, on behalf of Nuvama Institutional Equities, we welcome Dr. Ashok Panda, Chairman and Managing Director, along with Additional Director of Finance Charge of Steel Authority of India. I would request Dr. Ashok Panda to give his opening remark, and then we can open the floor for Q&A. Over to you, sir.
Thank you very much, Mr. Ashish Kejriwal. Good morning, everyone. I welcome all our investors and analysts who are joining this result con call for the financial year of SAIL for the period Q1 26-27. Though I am sure most of you might have already seen the results on the website of the company and through stock exchanges, I would briefly run through the same for the benefit of the house. When we look at the economic scenario globally, the period was impacted adversely by the geopolitical situation in the Middle East. Not only did it impact the supplies of fuel across the globe, it also affected the supply chain for inputs like limestone, etc. And even it also affected to some extent like the gas supplies, propane, etc. for the steel industry. On the other hand, the rising fuel cost led to inflationary pressures against raising the various expenditure heads. However, notwithstanding the projections for India also remain range-bound between 6.4% to 7.2% by various agencies over next 2 years. So far as Indian steel scenario is concerned, the landscape for the steel industry is highly influenced by economic trends, trade policies, and technological advancements. Indian steel industry, however, continues to enjoy robust demand for steel, with consumption during Q1 26-27, which has grown by more than 8% over CPLY. The production, however, showed a muted, slightly lower growth of around 3% during this year, during this quarter 26-27. Due to higher growth in imports as compared to exports, there was increase in imports as well as increase in exports, and the net import for Q1 26-27 was to the tune of around 0.4 to 0.5 million tons, as against maybe 0.3 million tons last year Q1. Now let us have a look at briefly look at the company performance for Q1 26-27 performance of Steel Authority of India Limited. Before highlighting the performance of the company during Q1 26-27, I would like to inform the House that owing to the circumstances that prevailed and the threat that loomed at large, SAIL decided actually to advance some of its major capital repairs during Q1 so that it will be free after that and will start producing better in the next quarters. Mostly we had major capital repairs in ISCO Steel Plant, Durgapur Steel Plant, and also Hot Strip Mill at Bokaro Steel Plant, which were done in Q1 by design. So that is the story about this Q1 compared to last Q1. While this impacted the production volumes as per design, but then ultimately it helped us in some of the things and which led to a good profitability going forward. Coming to the performance of the company during Q1 26-27, the highlights are as follows. Crude steel production stood at 4.8 million tons in Q1 26-27 as against 4.9 million tons CPLY. This reduction is because of the capital repairs which have been advanced in this Q1 by design. Sales volume was 4.2 million tons, which fell by around 7 to 8% as compared to the previous year. And there was increase in inventory by around 0.2 million tons in the finished goods. The company, however, remains very much committed towards increasing its sales volume, including inventory liquidation in the balance period of this year, as we've done last year as well. And also our endeavor will be to reduce the working capital borrowings. And when we look at the borrowing position as in 30th June 2026, at the end of this quarter, we are almost at the same level as that of the beginning of this year, in spite of the fact that the inventory has increased by 0.2 million tons. On the back of better realizations, sales turnover increased by well over 1% as compared to previous year quarter one. Despite significant increase in prices of major inputs like coking coal and fuel, limestone, the company was able to improve its profitability through measures towards operational efficiencies, better financial management and treasury management during this period of quarter one. EBITDA at 4356 crores for quarter one 26-27 has a growth of more than 50% as compared to CPLY figure of 2925 crores. EBITDA margin at 16.7% is one of the best since 21-22, when the steel market that time was at its peak and coal price was at its bottom in 21-22. EBITDA per ton also crossed a benchmark figure of 10,000 rupees per ton and stood at 10,464 rupees per ton in quarter one 26-27. While talking about PBT and PAT stood at 2159 crores and 1636 crores in quarter one respectively, as compared to 890 crores and 685 crores respectively for CPLY period, with a growth of around 150%. As mentioned earlier, the cash outflows were managed smartly through better treasury management efforts, which helped to keep the borrowings under check, and this stood at 21,729 crores as on 30th June, which is almost at the same level of as on 1st March 2026 was 21,663 crores. The debt equity ratio was further reduced to 0.36 on actual basis at the end of quarter one 26-27. Going forward, while Q2 has traditionally been a toughest quarter for the steel industry because of the rain, incidents of rain, etc., but efforts are being made not to increase an inventory during quarter two, and after that our efforts will be to reduce inventory in quarter three and quarter four, so that on the yearly basis there will be inventory reduction. We will continuously strive for increasing our efficiency levels and cost reduction efforts. Another good thing which has happened during this quarter 26-27 is that our focus on mines has been foremost. Now we are trying to increase production for our captive mines and as well as consume and the rest quantity to sell in the market wherever it is possible. And during this quarter one, we could have sales of around 400 crores more as compared to last year quarter one, and which has resulted in a profit of around 150 crores as compared to last year quarter one. So these are the highlights. With these words, I hand it back to Mr. Ashish for opening the Q&A session.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Alok Deora with Motilal Oswal Financial Services. Please go ahead.
Good morning. Sir, just had a couple of questions. First is if you could indicate what was the NSR in 1Q as against 4Q, and based on the July and how the prices are moving, what do you expect for the second quarter?
Quarter one average NSR was 57,100 as compared to quarter four of 52,000. That means an increase of around 5,000 rupees per ton between these two. So far as Q2 is concerned, as I have already told, because there is monsoon season right now, but traditionally there is always a reduction in the NSR. So far as Q2 expectation is concerned, or maybe when you talk about July, so the prices of the flat products, there is not much of a reduction in that. There are fluctuations in the long product prices. There were reductions, but recently there is a positive momentum which is visible, because of which there is a possibility of increase in long products price. So as we can see, you can say that between June and July, in the long products price, if there was a reduction around 3,000 rupees, around 3,000 rupees per ton, so maybe it will improve by 500 to 2,000 rupees right now in the long products. In the flat products, in between June and July, there could be a reduction of around 1,000 rupees per ton, something like that.
Got it. And how about the coal cost, sir? What was the coal cost on consumption basis in 1Q, and what's the guidance for second quarter?
The imported coal price in quarter 1, 26-27 was on a higher side, 21,300 rupees as compared to 18,100 rupees in quarter 4, means around 3,100 rupees increase. The index of imported coal, which was at a peak of around 235 a couple of days before, now it has come down to a level of 220 today. So that means there is some softening effect in the coal index, imported coal index, Argus and Flat and Argus index. We hope that because in the rainy season there are monsoon situation, etc., demand may come down, and because of that, maybe the prices will soften in quarter 2.
Okay. So any guidance on coal cost you can provide on? Yeah.
We are expecting that in Q2 going forward, maybe from August onward, there could be a reduction of around 1,000 rupees to 2,000 rupees progressively in the coal cost, in the imported coal cost on a monthly basis.
Got it. Just last question, sir. So based on the performance, are we maintaining the full year volume guidance?
Yeah, we are maintaining the full year volume, and we'll be having a growth of over last year by the year end.
Got it. That's all from my side, sir. Thank you and all the best, sir.
Thank you very much.
The next question comes from the line of Amit Murarka with Axis Capital. Please go ahead.
Good morning.
Good morning.
Hello. Good morning. So this first question would be on cost inflation in West Asia, if you could spell out the amount.
Your voice is breaking.
Amit, you're not clearly audible. I would request you to use your phone on the handset mode, in case if it's not on the handset mode. Hello, Amit, are you there? Amit, if you can hear me, please sort the issue with your phone and you may get back into the queue. Thank you. We'll move to the next participant, that is Ritesh Shah with Investec India. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, first is clarification, and the prior answer you indicated we expect coking coal prices to go down by 1,000-2,000 rupees into Q2?
I mean, on a monthly basis, actually, I'm not talking about the average, but when we look at month of August, maybe there will be reduction of around 1,000 rupees. Maybe in September, further 1,000 rupees. This is my expectation.
Okay, that helps. Sir, second is, can you indicate the volumes excluding RINL or any other sales that we have done for, say, NMDC steel for the quarter?
So when you look about that particular figure, so NMDC steel, as you know, actually we are not doing the marketing this year, so it is nil, almost kind of nil, NSL. But whereas CPLY quarter 1 had 3.73 lakhs of sales, this time it is 0. In RINL, we sold around 96,000 tons, which was not there last year in quarter 1. So on the whole, if you combine NSL and RINL, then last year CPLY, means last year quarter 1, had a quantity of around 2.76 lakhs tons in that, as compared to this year.
Perfect. Sir, just two quick questions. Sir, how do you see the pricing gap between primary and secondary longs? You did indicate that we are hopeful for long product prices increasing by 500,000 rupees. Sir, how should we look at the divergence between primary and secondary? That's one. And sir, second question is, how are we reading into the anti-dumping duty investigation which has just got initiated? And is there any probability of safeguards basically to be reinstated again?
Yeah, let me answer one by one actually. The first question is about the gap between primary and secondary. in the TMT, in the long products. So now the gap has narrowed down. The gap is around 5,000 rupees right now, which is a healthy gap. So that's the reason why probably there is an uptick in the NSR in the prices of the primary TMT products. This is my guesswork. And number two, you asked about safeguard duty and anti-dumping duty. In safeguard front, actually, yes, there is a safeguard duty still in place, which is 11.5% as of now, because it was there for 3 years. Today, now we are in the second year right now. So that still continues. It is giving the relief to the much needed relief to the steel domestic market. So far as anti-dumping thing is concerned, that is going on, and based on the investigation, maybe some measures will come as a relief to the domestic steel sector. Yes, please.
Sure. Thank you so much for the answers. Thank you.
Thank you.
The next question comes from the line of Parthiv with Anand Rathi Groups. Please go ahead.
Hi, good morning, sir. Thank you for the opportunity. So my first question is pertaining to the subgrade ore of fines. I believe you said that in the first quarter you did some extra 400 crores from sale of ore. So the question is actually divided in two parts. Number one is on the subgrade ore of iron ore, what you have, the inventory. The second is, if you see the recent auction data of Steel Authority, the volume has actually been going down, especially in the June month from a couple of mines. So do you expect this third-party sales of ore to continue? Just wanted to get your thought process on it.
Let me try to answer one by one. The last question I didn't get it, but the first question and second question let me take. The first question is about SGF, subgrade fines. We are having a volume of around 32 million tons inventory in the balance sheet, and we have put up in the auction around 3 million tons. The rates are yet to come, and we are hopeful that this time we'll be able to click that particular thing. So that will become a beginning of selling of our efforts towards selling 32 million tons going forward. Number two about sales from the iron from the mines. The sales from the mines is primarily from the Odisha group of mines, from where we've been selling iron ore fines, fresh iron ore fines, tailings from there. So the quantities have become more than twice as compared to last year. That's the reason why turnover from there has increased by around 400 crores and profit from there has increased by 150 crores. Our efforts are to increase our production further and sell more and more in the market. We are also planning to sell from Chhattisgarh group of mines. Two auctions have fructified recently, just few days back, which is in quarter two, and that will testify our possibility of increasing further sales from Chhattisgarh mines. And we are also trying to sell from Jharkhand mines. Efforts are on in that.
Okay, sir. So just one quick clarification: the 3 million ton is the 27 target, right?
Pardon?
For the subgrade. This is subgrade or over 3 million ton auction target is for the entire year of 27 or it's for 28?
No, this is the first case actually. Once it happens and starts moving, then we'll also see.
Okay.
Of course, that is the target. That is the target for 26-27.
Okay. And also, I believe, just wanted to quickly get your understanding on the railway price revision. Whatever you can share, what is your expectation? How are we supposed to see that, going forward for the current year?
Yeah, all that I can say is, that it is based on the provisional prices, rail price. You're talking about rail price, isn't it? So,
yes, sir.
So for the year 26-27, because the imported coal price is on the higher side and our provisional price is pretty low at 74,000 rupees. So we are expecting a better price as compared to that. And so that is going to improve our profitability whenever it is declared.
So are you expecting anytime soon?
No, for 26-27, it will come in 27-28 and 25-26 prices will come in 26-27. So we will see how it comes out at that point.
But do you have any preliminary understanding for last year's pricing, sir?
I mean, 25-26 prices will be more than that of 24-25 prices. It all depends how it gets. And this may get...
Okay. So, and if I may just quickly squeeze in the last question from my side. I think recently Government of India imposed a definitive ADD on met coke for I think about 5 years. Would it be impacting you in any sense? Because I think...
It is not going to impact sale because we have our own capacity which is equivalent to our requirement or maybe some.
Okay, sir. Perfect. Thank you so much, sir. That's quite helpful.
The next question comes from the line of Pinakin Parekh with HSBC Bank. Please go ahead.
Yes, sir. Three quick questions. First, can you give us your updated capex guidance for this year and the next couple of years, given whatever the plans are?
Yeah. So far as capex is concerned, this year we're planning a target of 15,000 crores, and this is going to increase in next 2-3 years because our expenses are on. That means next year it could be in excess of 20,000 crores, and after that maybe 25, 26 like that. So it will go on increasing for next 4-5 years. This year it is 15,000 crores, and we are likely to complete that.
Got it, sir. My second question is, sir, you said that, NSRs are basically July was better than June. But if I take the average NSR for the June quarter, the first quarter versus what has happened in long product prices, 2Q NSR should be broadly be down by 2,000 to 3,000 rupees a ton or flat, or how should we look at it?
When we talk about the NSR, actually I said that quarter one of this year, NSR is higher than quarter four. But in quarter two, that is starting July, the NSR will be less than that of quarter one, primarily because of the monsoon and dull demand and all that. That means in what I said is that in July, August and September, so reduction in flat prices may not be that much, but reduction in TMT means LP, long products, will be more actually. So in June and July, while there was a reduction of around 2,000 rupees in NSR of long products, recently there is an upward momentum for the long products NSR. It might further increase by 1,000 rupees. So kind of, if you talk about quarter two NSR as compared to quarter one could be down by around 1,000 to 2,000 rupees, maybe. This is just a guesswork.
Got it, sir. And so my last question is, can you give us an updated guidance for your employee cost for this year and whether you will start providing for the wage provision in the January-March 2027 quarter?
Yeah. Salary wages this year in quarter one is 2,937 crores as compared to last year figure of 2,944, almost at the same level. While in this quarter one, it includes the VR, the differential VR amount, VRS, voluntary retirement, because our VRS scheme is on. So many people have taken VRS. That factor is also there in the employee remuneration. The number of employees are coming down and VRS is on. So we're expecting that the employee cost should come down, number one. But coming to your point of wage revision possibility, so there in quarter four, we'll look at the probability and possibility of making some provision towards wage revision. Those aspects we will evaluate and examine in quarter four, because that time it will be due. So a particular group will look into that.
Got it, sir. Thank you very much.
Thank you. The next question comes from the line of Pallav Agarwal with Antique Stock Broking. Please go ahead.
Yeah, good morning, sir. Just a couple of questions. Your first one, can you just update us on what is the current product mix, break up between flats, longs, and semis?
Yeah, just one sec. It's almost kind of 50-50%, and one thing is that the semis have come down. The semis have come down from say 14% last quarter one to 11% this quarter one. And between long and flat, the long is flat is 52.7%, long is 34.8%, and semis are at 12.5% in quarter one.
Sure, sir. Because in the slide, in your sales performance slide, the proportion of semis is showing as 6%. So are we getting some semis converted outside and then into finished products?
Yeah, of course. Semis are getting converted to finished goods. That's the reason why I told you that the finished steel has gone up from 86% to 89% this year. So we are trying to convert most of the semis into finished and pushing that in the market.
Okay, so I think the slide mentions 6%, so maybe that's after conversion. The final sales is about 6%.
Correct. You are right.
Okay. So also in terms of the coking coal, what is the breakup? I mean, most of it is imported, but how much are we getting? Are we getting anything from our captive mines, and what is the proportion from Coal India?
Yeah, captive mines actually is from Tasnala and Tasra. So that is a part of the indigenous coal, that is not a part of the imported coal. So imported coal are at around 85%, indigenous coal is 15%. So out of that 15%, we get somewhere around 5% from our own mines, and which is likely to go up from December onwards, because production from Tasra mines, which is under development right now, is going to take place in the month of, expectedly in the month of December. So fourth quarter will be better quarter expectedly for us, in which we'll be getting more indigenous coal from our captive mines. And this will also give an advantage in terms of pricing.
Yes, sir. So could you just give us some idea of, what is the, cost benefit of indigenous versus imported coal?
See, in quarter one, the indigenous average price is 13,100 rupees as against imported price of 21,200 rupees. That indigenous is 13,100, but when we'll be getting from our own mines, it may be somewhere around 5,000 to 6,000 rupees, around 6,000 rupees. So that component is going to increase from December onwards.
Sure, sir. Also, sir, this lastly, if you could just give us a sense of, in our coke ovens, what is the sort of blending? You've given the PCI, the coke rate, and the PCI injection. So broadly, what is the proportion of pure hard coking coal that goes into our, coke mix?
Just one sec. The percentage of hard coking coal, the percentage of soft coking coal is around 25 to 27%. So the rest is hard. And within that also, in totality, if you look at, our imported component is around 85%, indigenous component is around 15%. That is on the whole. But when we want a backup between soft and hard, soft is around, what percentage? 23%. 23% is soft, and 61.7 is around hard coking coal. Means actually indigenous coking coal is 15%, then imported hard is 62%, and imported soft is 23%. That is how it becomes 100%.
Sure, sir. Okay. Thank you so much.
The next question comes from the line of Sumangal Nevatia with Kotak Mahindra Bank. Please go ahead.
Yeah, good morning, sir. So I just want to clarify a few things. One is the fourth quarter NSR you said is 57,100, right? Can you share the breakup of flat and long?
Yeah, fourth quarter is NSR is...
Sorry, 1Q. Sorry. I meant 1Q.
Yeah, 57,100 is the average, out of which almost same. Long is 57,100, flat is 57,200. So it is average 57,150 to be precise.
Got it. And sir, what is the July NSR for long and flat?
July NSR average is 55,600. The flat is 56,900, and long is 54,200.
Understood. Got it. Sir, for the captive mines, when we shared that sales was 400 crores, profit was 150 crores, can you share what was the volume here? And for the full year, what is our expectation?
So volumes are 1.1 million tons, and last year quarter one was 0.31 million tons. And when it is 1.1 million tons this quarter, last year we sold around 3.odd million tons. Although we are targeting a very high target of 8 million tons, let's see how far we can go.
Okay, so last year we sold 3 million tons for the full year.
For the full year, around 3.5 or something million tons.
And what was the revenue and EBITDA contribution of iron ore volumes last year?
Last entire I just check up actually, but I can tell you about the quarter one. I can tell you about the quarter one actually. In quarter one, as I told you, the turnover from the sales of iron ore was 157 crores last year quarter one, and in this year quarter one it is 574 crores.
And EBITDA for this year is 150 crores, right?
Yeah.
For 1Q.
You can say it is roughly the EBITDA also.
Okay. Okay. So in the past, we've not been able to achieve our guidance because there's been some logistic constraint, and I think even for subgrade mines, the demand for that quality is not there. So are those constraints now receding? What's the status on that?
Logistics constraints are still there. We are trying to vie with that through better availability of rakes as well as by enhancing our quantities through road. So those are the efforts we are making so that the logistics constraints to some extent can be eased out. Those things are going on. And regarding the quality of the iron ore, subgrade fines, there is a lot of demand for the subgrade fines as well as tailings because these are not very low quality subgrades. These are 59% to 60%. And they are having it is having a good marketplace. Even in case of tailings from Bolani, that means from Odisha group of mines, which are 57, 58, 56%, that is also having a good market demand. So market is good for that. We can achieve our sales quantities.
Okay. And just one last question on the coking coal. So you said consumption was around 21,300. What is the likely consumption cost for 2Q? I mean, do you expect a reduction or an increase in consumption cost? I understand purchase is getting lower.
Yeah. It will reduce because now the price is softening, so it will reduce only. Maybe there will be a reduction of around 1,002 or 1,500 rupees in Q2 compared to Q1.
Understood. And sir, 1Q, what was the capex spent? Just last question.
2,575 crores.
All right. Okay. Thank you and all the best, sir.
Thank you. Thanks.
The next question comes from the line of Amit Murarka with Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity again. So, first question is on the cost inflation which has been there. Generally, we have seen the impact of West Asia coming through on power costs and other raw material costs. In your assessment, what would have been that inflation in Q1 for you?
The increase is primarily from two fronts. One is on the coal front because, as you know, there is an increase of around 3,500 rupees in the imported coal prices compared to last quarter one, which is easing out right now. So that is one thing. The other thing is fuel cost has gone up to some extent. It has, of course, not impacted sale per se so much, but the impact of the limestone, increase in the limestone cost is also there in our cost of production. So these are the broad things which have impacted the steel sector in totality. But the impact on us is less compared to others because the impact due to fuel is not much in our case.
Got it. And also just to understand, you said that you are processing some semis from third parties. Who would be these third parties, just to understand?
We have the conversion arrangements and that is the domain of the marketing, and we keep on doing it dynamically so as to reduce the semis availability in the market. We are trying to improve our finished steel more and more. That is the reason why I told you there is an increase of around 3 to 4% in finished steel percentage this year as compared to last year quarter one.
And the arrangement with NINL has stopped, or how is it working right now?
No, it is not a conversion arrangement with NINL. We are supporting them in terms of selling their semis whenever they want.
So in Q1, was there any volume then from NINL?
NINL sells quantities 96,000 tons of semis through our marketing setup.
95,000 tons. Okay.
It is not actually NINL. It is RINL. Sorry. It is RINL.
Sorry, my bad. Not NINL. I meant, sorry, my bad. I meant NMDC Steel. Sorry. So NMDC Steel.
NMDC is zero, as I have already told.
Okay. Okay. Thank you so much. Yeah.
The next question comes from the line of Netra Deshpande with Myri Asset Sharekhan. Please go ahead.
Thanks for the opportunity, and good morning everyone and good morning management. Just my first question about the last quarter that you said about flux and the limestone expenses has increased on account of Strait of Hormuz in Dubai. So any impact on that about the sellable steel, because as we have seen in that reduction of around 100 to 200 per ton. So in the coming quarter also, is there any?
Let me explain this particular question a little bit more. That because of Strait of Hormuz, actually, that is Gulf War situation, there is an impact on the fuel as well as in the limestone and the steel sector. So far as fuel is concerned, so far as Steel Authority of India Limited is concerned, we do not have much of an impact because we have our own gases produced inside the plant itself. Coke ovens are healthy, blast furnaces are healthy, we could produce the gases, use it, not much of an impact. So far as fluxes are concerned, in the fluxes, because of this ocean freight, etc., the prices have gone up for everybody and so also to us. But the impact of that increase in the prices of fluxes have been offset by reducing the specific usage of fluxes in this quarter one compared to the previous quarter one, and because of that reduction, we've got a saving on that count by around 25 crores. So more or less, it has offset the price increase due to ocean freight in the fluxes.
Okay, noted, sir. And so secondly, it is about the debt position. What is at present, like in the last quarter, like the finance costs have declined and that remained as a major deleveraging, supporting the overall debt, and to debt equity ratio has also maintained to the multi-year low of 0.55. So what would be the this deleveraging in the trend which is going to continue for the Q1 FY27? What at the current position?
Yeah, at Q1 level,
yes.
The debt is standing at 21,729 crores, which is almost at the same level as that of the opening of 21,663 crores. The debt equity ratio has come down to 0.36, maybe from 0.38 or 0.39 in the opening of this year. So deleveraging efforts are on, and so far as today's position is concerned, the debt has further come down to a level of 21,400 crores. Efforts are on to reduce the working capital borrowings in this particular year by reducing the inventory as well as through other sources for improving the cash flows. And apart from that, actually, due to concerted efforts by treasury management, better treasury management, our cost of debt has also come down to a level of 6.24% as compared to last year quarter one of around 6.8%, and because of which there is a saving of around 100 crores in the finance cost this quarter compared to the previous quarter.
Okay, got it. And so the last, it is only about the blended gross spread. Can you give me some figures for the Q1 per ton, like blended realization you gave for the blended gross spreads?
Blended what? I could not get your question.
Gross spreads. So between like the segment, the product mix, like, about the blended realization breakup that you have shared, about any yeah.
So you want to say blended realization in terms of NSR?
NSR, yes. I mean, you can say about it. Blended realization that you have already mentioned about long and flat, but the sellable steel, do you have any particularly?
I just said to you actually, so far as blended realization is concerned in quarter one, our average NSR is 57,156, and within that, when you look at the breakup, the flats are at around 52%, and long is around 38%, 12% is semis. That is in the production front. But as somebody told, actually, the sales front, the semis are still less by around 6%, because the rest 6% has been converted to finished goods. So in totality, our blend has improved in this quarter one as compared to the previous year.
Okay, sir. Got it. And sir, about the subgrade auction grade that you said about FY27, it would be 3 million tons. So for the sales from mines, Orissa and from Jharkhand mine, can you elaborate or give some data?
Yeah, let me tell you the expectation actually. Last year 25-26, we had a total sales of around 3.odd million tons. And all of that had happened from Odisha group of mines. So that includes the fresh fines as well as tailings from Odisha group of mines. This year we are expecting double the quantity from Odisha group of mines, some quantity from Chhattisgarh group of mines, for which the auction is fructified just few days back with a small quantity, but that is a testimony that we can increase further depending on availability. In the Jharkhand side, actually, we are making efforts to sell our subgrade fines, which we are expectedly it is 3 million tons. Let's see how much it will go out. And number two, we are also trying to sell the fresh fines from Jharkhand. Numbers I cannot give at this point of time.
Okay, sir. Got it. Thank you, sir. Thank you for the answer.
Participants, in the interest of time and fairness to others, please restrict yourselves to 2 questions. For any more questions, you may rejoin the queue. The next question comes from the line of Vikas Singh with ICICI Bank Securities. Please go ahead.
Good morning, sir, and thank you for the opportunity. Sir, just wanted to understand the downward revision in rail pricing. What was the benchmark previously, and what is the benchmark now at which you are selling? And for FY26, considering the costs are down, what kind of further downward revision can come?
Let me explain you. Actually, there is no benchmark actually in that. It is guided by efficiency and the coal prices primarily. So it goes up and down depending on the input prices and the efficiency level in our rail mills. These days, our rail mills have a very high level of efficiency, which is even better than the global benchmarks. So that is how it is working at Bhilai Steel Plant for rail production, and it is well appreciated by Indian railways as well. Going for, as I said, in 24-25, because imported coal prices are remaining low, that is why the prices were low. In 25-26, there is improvement in the imported coal prices compared to 24-25. So we are expecting better prices compared to 24-25. In 26-27, the imported coal price is still higher, much higher as compared to 25-26. So of course, the costing will be more and the price will be more, which will be decided in 27-28. So that is how it moves.
So you are not expecting any further downward revision in the railway prices as of now?
We are not expecting any further hit on a P&L on account of that.
Noted. And so my second question pertains to your DSP plant, basically, that had the highest degree of semis. There we were actually putting up some casters to increase the overall... Hello?
Which plant you said? SP plant?
So DSP plant.
Okay, Durgapur.
Durgapur Steel Plant, that has the highest semis. So there we were actually putting some projects to increase the finished goods product. I think the caster which we are putting. So could you give us some update on at what stage that is, and how much tolling charges we are giving for the semis to finish conversion to the third party?
Let me answer your question. Durgapur, we are producing semis and which is in excess of 1 million ton per annum. Because of that, actually, we are putting up a TMT bar mill over there, and that will produce around 0.8 million tons, 0.8 to 0.9 million tons of TMT from there, and that is expected sometime in 2027, maybe September to December 2027. That is the expectation. During that time, it is going to come. Once that comes, then availability of semis from Durgapur will come down drastically. Conversion charges, as you said, actually, these are dynamic in nature based on certain formula, etc. This remains with the best standards of the industry.
The next question comes from the line of Ritesh Shah with Investec India. Please go ahead.
Sir, just one quick question. What is the total wage commissioning provisioning that we are doing right now? And would it be possible for you to give a number for employee cost for this year and next year, considering this variable?
What commissioning you said? Wage provision. Wage.
Sir, pay commission. Yeah.
Yeah, pay commission, as you know, it is going to come from 1st January 2027. We are not much sure about it, neither there is any calculation available over there. As I said clearly, in quarter 4, we will evaluate, examine and see what is possible in terms of provision.
Sure. Thank you. That's all.
The next question comes from the line of Akhilesh Kumar with Emkay Global Financial Service. Please go ahead. Akhilesh, please go ahead with your question and unmute your line in case if you are on mute.
Yeah, hi. Can you hear me?
Yeah.
So my question is, how are we looking at the cost efficiency program panning out, and what are the exact initiatives we are taking to bring the cost down, and how much of per ton cost saving you would see to come from these initiatives, let's say over FY28 and 29?
28 and 29?
Yeah, how much of total, in terms of rupees per ton, how much of cost savings we are looking at?
See, we are looking at a cost reduction of around 2,000 to 3,000 rupees in this year itself. In quarter one, because many of our units are down because of the advancement of the capital repairs, so the cost was little on the higher side. So from quarter two onwards, because all the mills and facilities are in place, so cost reduction efforts will be there and the cost reduction will be there, number one. But when we look at a possibility of cost by 28-29, by 28-29, we'll have new facilities coming up in ISCO steel plant, and which will reduce the variable cost drastically because of reduction in the fuel rate, coke rate, etc. over there. So that time, the cost reduction in the variable cost could be to the tune of 3,000 to 4,000 rupees per ton. But however, because the new units will come, naturally they will be pushed in terms of fixed cost at that point of time.
So all in all, if we have to look at net cost per savings, because there will be some costs which will be coming up because of the new plants coming up also. So can we fairly say that 1,500 to 2,000 rupees of per ton cost savings will directly flow into our EBITDA?
Correct. You are very much right. It will by 28-29 when we start getting production from ISCO steel plant expansion units. The variable cost will come down by around 4,000 rupees and fixed cost may go up around 1,500 to 2,000 rupees. Net, there could be a cost reduction of 2,000 rupees at that point of time. But notwithstanding that, before that, from our current operations, we are trying to reduce our cost of production by around 2,000 rupees through various efforts.
Thank you. The next question comes from the line of Rajesh Ravi with HDFC Securities. Please go ahead.
Yeah, hi sir. Am I audible?
Yeah.
Yeah, hi sir. I have two questions. First, given that the volume decline and the low capex which we have done in Q1, could you give us a sense of what we are looking at to maintain our full year volume and capex guidance? And also, second question, the iron ore volume and revenue which you shared for Q1, could you also share that same number for Q4 FY26?
Yeah, let me tell you actually, so far as capex is concerned, Q1 capex target was 2,306 crores, against which we have met 2,575 crores. Our yearly target is 15,000 crores, and we are going on stream to achieve those figures. That is number one. And number two, on the volume front, as I told you, there is a reduction of around 0.1 million tons of production. That is because we advanced the capital repairs at ISCO, at Durgapur, and at Bokaro hot strip mill. So that was by design. So in Q2, Q3 and Q4, the production volumes will be more than that of last year. And on the yearly basis, there is expected to be a growth as compared to 25-26.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I would now like to hand the conference over to the management for the closing remarks.
Yeah. From me, as a closing remark, thank you very much for your Q&A session. The forecast for Indian economy by various agencies have been quite encouraging, and support by the government is strengthening the belief that the economy will continue to do well going forward. Steel demand also continues to prosper, and we are hopeful that the prices will maintain the momentum that has been gained post-monsoons. Apart from the improvement in the operational performance, the company also remains committed towards sustainable performance, including emphasis on decarbonization, improving capacity utilization, value addition, and achieving cost competitiveness. I thank all our investors for their reposing faith in us, and I am hopeful that the same shall continue in future as well. Thank you very much.
Thank you, sir. Ladies and gentlemen, on behalf of Nuvama Wealth Management, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.